Hello, and welcome to the Get to Know Hedge Fund Investing series with Carl, the Carl Investment Platform. I am once again Jamie Uppenberg. We are nearing the end of our series, just a couple more sessions. And again, we're really hoping that you are getting closer to getting into the mobile app, looking at these investments for yourself, and being able to sort through the statistics and make the right investment decision for your portfolio. What's going to work best for you? To that end, and I know I've talked about it a couple times throughout the series, today I'm actually looking at a diversified Carl portfolio, and I'll talk about the performance on that portfolio. Because as much as we've gone through individual investments, if diversification is the number one reason we see investors coming to the platform, it makes sense to even diversify your hedge fund portfolio. And we see and have seen, even just in 1 year, how that can make a huge difference to a portfolio. Because if any one investment isn't performing the way you want, well, you've got a lot of help in the world of hedge funds. They are uncorrelated. They will behave on their own, at least the Carl hedge funds. Not true of all hedge funds. There are a lot that are correlated. But of our hedge funds, they'll perform separately. And statistically, we're seeing it really matter within portfolios. So historically, statistically, which is not always indicative of future performance, but let's take a look. In our Carl portfolio, and I think you'll see this on our website in the coming weeks, we will post at least the basics of this portfolio. We have a 30% Victory Peak, 30% Kilimanjaro, and 30% K2. And then we did put that insurance of a 10% Olympus investment in this portfolio. So a bit of a full tail hedger insurance in our example portfolio. Denali's just come on the scene, so we haven't diversified this into Denali yet. We may do that soon once the strategy goes live. But this is, 4 hedge funds in one. It's a pretty good diversified hedge fund portfolio. So 30, 30, 30, 10. This portfolio is, it has, I'm still looking at the 4 years and year to date, and the growth of $100, it is 232 to the S&P's 197. So it gets you there. These statistics I'm providing are pre-fees, so you do have to consider fees into this mix. While you would still outperform the S&P and generally take on a lot, well, it depends on your perspective, but my perspective is this is significantly less risk. Now, again, we've talked many times, we have a lot of hedge fund investors who a big part of the purpose of diversifying and getting into hedge funds is not just those high targeted gains, but that they take on less risk, which means they keep more capital working in all markets. And that's what these diversified portfolios can do. So diversified hedge fund portfolios. I'm just going to give you a couple of highlights. The largest monthly loss in this portfolio over this period is 2.8%. That's compared with the S&P's 12.51%. So I'm going to say it again, like the largest monthly loss for this portfolio, 2.8, and the S&P 12.51. The worst drawdown, 3.52, and the SPX is 34, well, 33.92, I'll be very precise, but about 34%. So recovery period, 6 days for the Carl diversified portfolio. The recovery period for the S&P, 92 days. For most people, the amount of risk that they're taking in this portfolio against the return opportunity, it's strong. Now, these are investments. None of this is guaranteed, but when you are diversified, there is so much more opportunity for gain. Particularly in investments that I know I'm a broken record. You guys are probably tired of hearing it, but to have investments this way uncorrelated, it tends to create some strength, at least in the historical statistics. For those of you who are super investment heady, I will give you the Sharp. You've got a 2.63 on the Carl portfolio to a 0.96. That's a 0.96 on the S&P. So I had to take one session to talk about diversification with a series of uncorrelated investments in hedge funds and the type of strength you can get on both sides. the type of returns you could be looking at, and the risk profiles you could be looking at. These are investments, anything can happen, but the more you spread it out, I mean, you'll look at a lot of white papers on diversification. This is a lot of opportunity that has not been here before. That's definitely true. We haven't had a chance as just regular accredited investors to create something like this before. So that's new. And I firmly believe if you're looking at the 60-40 is dead, you have a lot of articles that say that it just doesn't work like it used to. Getting these types of investments in this diversified way, it's definitely something to look at. If you're looking at, well, if I'm not doing the old 60-40, what am I doing? Right? Something to take a look at in these stats and see what makes sense. As always, this is your portfolio. You have to decide what's right for you, but we are really hoping, and the goal of this series is that you can go into the mobile app, take a look at the individual investments, put maybe a diversified portfolio together, look at those statistics, and then see what makes sense for you. We have maybe 1 or 2 more sessions here, so we'll wrap this up soon and talk with you next time.